Welcome to Vivid Box HQ. A new Fed chair just inherited an inflation shock and a direct conflict with his own president over interest rates. On the Wall Street trading floor, bond traders are doing something strange. They're pricing in a Federal Reserve rate hike in 2027, betting against the man Donald Trump just handpicked to cut rates. The new Fed chair, Kevin Warsh, was confirmed on May 3, 2026, 54 votes to 45, and the market's verdict landed almost immediately. Treasury yields climbed. Inflation expectations drifted higher. Both moved against the chairman before he'd even sat in the chair. The data we reviewed shows markets are now pricing a rate rise in 2027, a direct challenge to the supply-side framework Warsh built his career on. Here's why it matters to anyone with a mortgage or a car loan. When bond markets bet against a Fed chair, borrowing costs stay high across the whole economy. Mortgages don't fall. Loans don't ease. The world changed under Warsh's feet. The Iran war that started on February 28 sent Brent crude to $111 a barrel. Headline inflation jumped to an annualized 4.1% in the second quarter. Every trader watching those screens knows what the Fed knows. You can't talk an oil shock down with a press conference. So they're calling Warsh's bluff before he's gavelled his first meeting. The bigger question this whole video circles back to: can the man Trump installed for lower rates actually deliver them? That ideology is what made Warsh Trump's pick, and what's now colliding with reality. Kevin Warsh isn't new to the Fed. He served as a governor from 2006 through 2011, through the heart of the financial crisis. He left an orthodox inflation hawk. He came back something else. The new Warsh argues America is in the middle of a positive supply shock, that artificial intelligence and Trump administration policies are juicing productivity, and that the Fed's interest rates are far too high for the economy actually emerging. In his framework, lower rates simply catch up to a faster, leaner economy. For ordinary households, that pitch sounds like a gift: cheaper mortgages, cheaper car loans, cheaper everything. He also wants the Fed's balance sheet, the trillions in bonds it holds, shrunk faster than current plans allow. He's even proposed cutting the number of FOMC meetings from 8 down to 4, with fewer press conferences and less forward guidance. Quieter, smaller. A central bank that talks less and acts faster. That's the Warsh pitch, and it's why Trump wanted him. The president has spent months attacking Fed independence in public, and the man he installed is the one figure on Wall Street articulate enough to dress cut rates in serious economics. But the markets aren't buying the story, because the data on the ground tells a very different one, and the difference between Warsh's model and what's actually happening is where this whole video lives. Watch the line spike in February 2026. That's the moment Iran's escalation closed the Strait of Hormuz, 1/5 of the world's seaborne oil. Brent crude jumped to $111 a barrel by Q2. U.S. inflation forecasts were dragged up to 3.20% for the year, 4.1% annualized in the second quarter alone. The trend, the numbers expose. An oil shock this size doesn't fade in a quarter. It rewires expectations for years. On the left, Warsh's framework. AI lifts productivity. Trump policies juice supply, rates fall. On the right, what bond markets are actually pricing. Oil at $111, inflation sticky, rates anchored higher for longer. Both can't be true at once. The data points to a Fed chair walking into his first meeting with the market already betting his model is wrong. That collision puts the Fed's independence directly in the firing line. For decades, Kevin Warsh has argued, in speeches, in papers, in op-eds, that central bank independence is the single most valuable asset a modern economy has. It's what anchors inflation expectations. It's what stops politicians from printing their way out of every problem. He has called it the bedrock of stable growth. And then Donald Trump nominated him. The same Donald Trump who spent months publicly attacking the Fed, demanding lower rates, treating Jerome Powell as a personal antagonist through the previous chairman's final year. The nomination, by every credible read, was predicated on a private understanding. Warsh would deliver the cuts Trump wants. That's the contradiction sitting at the center of this chairmanship. Defend the institution he's championed his whole career, or deliver the rates the man who appointed him demands. You can't do both. Oil sits at 111. Inflation just punched through 4%. And at Jerome Powell's final meeting on April 28th, the committee handed down 4 dissents, the largest since 1992, with 3 of those 4 wanting to scrap the Fed's easing bias entirely. Translation: most of the people Warsh now chairs were already pushing against rate cuts before he walked in. The man Trump picked for lower rates inherited a room that wants higher ones. If Warsh holds rates higher to fight the oil shock, the pain spreads instantly. Capital flees emerging markets for safer U.S. yields. Currencies sink. Debt costs spike. Bangladesh sits in the worst position on this map. Foreign exchange reserves at just 4.4 months of import cover, with almost no room to defend the taka if traders move first. The data points to Asia and Latin America absorbing the shock America chose. To see how a Fed chair handles a moment like this, rewind to 1979. Paul Volcker walked into the Fed with inflation running double digits and the US dollar collapsing. His answer was brutal. He raised the federal funds rate above 19%. 2 recessions followed, back to back. The inflation broke, but so did a generation of borrowers. Volcker became the patron saint of every Fed chair who has faced an inflation shock since. The lesson the institution taught itself for 45 years: when prices run, you crush them, and you accept the political cost. That's the playbook. Here's the gap. Volcker was a hawk in his bones. He believed inflation was a monetary problem. Full stop. Too much money chasing too few goods, fix it by tightening. Warsh is a supply-side thinker. In his framework, faster growth and lower rates can coexist with stable prices, because AI and administration policies are doing the disinflationary work for him. The trouble is, the Iran war isn't a supply-side problem in the way he means it. It's the opposite, a supply choke on the most important commodity in the world. The thing Warsh's philosophy is least equipped to answer is exactly the thing landing on his desk. Volcker had the conviction to inflict pain because he believed only pain would work. Warsh has built a career arguing the opposite. Beautiful theory, wrong decade. Those 90 days start with a date on the calendar, June 16th and 17th, 2026, Warsh's first Federal Open Market Committee meeting as chair. Wall Street traders are watching. So is every finance minister from Jakarta to Buenos Aires. And inside Trump's White House, the staff who pushed Warsh's nomination are waiting for the rate cut they were promised. If he holds rates, he keeps faith with the institution he's defended his whole career, and signals that Fed independence survives the Trump era. The market pricing a 2027 hike calms down. Emerging markets get breathing room. But Trump gets nothing. He was promised, and the public attacks on the Fed will only intensify. If he cuts, he delivers the political ask. But he tells the world that an oil shock and a president's preference now outweigh 45 years of credibility. Bond yields don't fall on that decision. They spike. The dollar weakens. Every emerging market currency already wobbling starts to crack. That's the trap Warsh walks into. A Fed chair appointed for alignment, walking into a meeting where the alignment itself is the problem. The story this video has traced: Trump's pick, the supply-side bet, the Iran shock, the markets calling it. All of it converges in one room on a Wednesday afternoon in Washington. For 45 years, the world has trusted the Fed to be the adult in the room when politics screams for easy money. In 90 days, we find out if that's still true. That's the Fed's 90-day reckoning. Like this video if rate independence matters to you. Subscribe for geopolitics that shapes markets. See you tomorrow.